How did you get to
And
that
yeah,
realization of like, okay, I can buy a business, especially when you're in this tech world, this startup world, this venture world of raising and just growing and growing and growing, and we're going to be a
totally.
billion-dollar company. How did you make that mental shift over to, well, I could just buy an existing business?
Well, first of all, I think my dad's business is like traditionally debt financed, small, like it's a larger business, but it's small business relative to like what we were trying to build at Brewbike. And so he would always look at our financials and be like, what is this? Like, what is this startup? Like, it makes no sense. How are you able to raise all this money? Right. And then and also I think I had gotten to a point where I was also like, what is this? Like, how is this ever gonna work? um it's it just didn't make sense to me. But like the business, like, right, a bunch of student run coffee shops on all these different college campuses, that could have worked if we had focused on making each campus really profitable and generate cash. And I always was like, I wish I could do that. So I was in my head kind of reverting to this cash flowing small business theme, that's what I was kind of seeking next, right? And so I something that was more sustainable, if you will. That's what I would talk to my entrepreneur friends about. I have a bunch of entrepreneur friends, and we would always talk about this stuff, right? So, like our friendship, um, and so I was sitting one day with my buddy who had gone through Kellogg, and he talked about ETA, which is Entrepreneurship Through Acquisition, and he told me all about, which is what I did. It's right, acquiring a business and becoming an entrepreneur through that. And so I I ended up reading a few books about it. Buy Then Build was really the one that hit home for me. It's so Walker Deibel wrote this book about um, how to buy a small business as an individual, would not with a search fund. There's kind of two different. There's search fund entrepreneurship, which requires raising outside capital, buying a larger business and owning a smaller percent of it, but a lot less risk involved, probably no personal guarantee on a loan. Um, and you don't have full control over the business. And then essentially your search fund is more like you're organizing a private equity deal, and then you're the operator in the private equity deal with more equity than a general, like any if you were to go in on a private equity deal that had already occurred, because you organize the whole deal, so you have more, you get a little bit more equity. um and then the self-funded search is generally with this SBA loan, Small Business Administration, so it's a federal loan, and it's called the 7A loan. And at the time, in ZERP times, when I was searching in July of 21, and kind of when the book was written, um, you could finance 90% of an SBA loan up to $5 million, right? So, and the businesses are valued at 2 to 4 times discretionary earnings, or EBITDA plus whatever the seller was taking home. So let me like kind of break
Yeah,
that down a little bit
break
more.
it down. Yeah.
So you could buy a business. This is just the self-funded search path. And this was the math that I was doing in 21 when interest rates were a lot lower. Now you need to bring more equity to the table more often. And it's a little bit,
I.e. more cash
it's,
out of your own pocket.
or you can bring in a few investors. And I could talk a little bit about, let me first talk about what the deal structure was, and then I'll talk about how it's changed. So I wanted to find, you could buy a business up to five, you could take out a loan up to $5 million with this program. So let's talk about a $3 million business, right? Um, the businesses that are like in that you can target and buy with this loan are generally doing, let's say, sub $1 million a year in EBITDA, or what it's called is seller's discretionary earnings. And that's how much profit the business brings in. And then you add in whatever the seller's taking home as a salary or dividends or whatever. So,
And the
um,
seller is really, the person who's been the entrepreneur, the person running the business. So it's their total
correct.
compensation plus the profit. And that's kind of the baseline
Exactly.
multiple that the deal is valued off of.
And a lot of times in these little businesses, they might be doing 3 million a year in sales and showing on the P&L a net income of $300,000, and that's because the seller's taking home $500,000 in, and that's in the operating expenses under wages and salaries, right? And so you would you would add that in, and then the actual earnings of the business would be $800,000, right? And so that would be, you would then multiply that by 2 to 4 times. So it would be somewhere between 1.6 and $3.2 million business. That's kind of that's pretty much how deals are structured in this sub $1 million EBITDA range. For these small businesses that are not like fast growing startups, but fast growing startups are usually not traded at this size. So they usually only trade when they grow to much larger sizes, because there would be no return for investors and founders if they sold at this size. Anyway, so right, so that 1.6 to $3.2 million business, that's earning 800,000 a year in discretionary earnings, would trades for 1.6 to 3.2. And at the time when interest rates were very low, I could finance that acquisition I could take out a loan for 90% of that. So
You borrow 90% of that purchase price from the federal government. Basically, what, 2% interest or something crazy low?
I had a 6% interest rate on my loan.
Yeah.
Fixed for 10 years. Most people didn't fix it at the time. Most people had variables, so now it's up at 11 or whatever. But it was actually like the smartest decision I've ever made. I paid like a few quarter points more to fix it, and I've saved so much money. Anyway,